good afternoon, everyone. It's been a long and content-rich day, so thank you for staying with us for the last but certainly not the least session. In this session, we will look at how payments are changing, the transformation of money from something we hold to something we tap or click, and with the focus on digital currency, of course. Digital currency is no longer a distant concept. It's already here. It's changing the way we think about payment system and the way we exchange value. We will look at what this means for central bank, commercial banks, users, and payment system in general. Before we begin, let me briefly introduce my distinguished speakers. Mr. Bilgehan Kürşad from the CBRT. He is the Deputy Executive Director in Payment System and Financial Technologies Department. He leads the Digital Turkish Lira project, and he has over 15 years of experience in financial innovation. And Mr. Sebastian Geiger from the Deutsche Bundesbank. He represents the German Central Bank in Turkey, and he works at German Consulate General in Istanbul. Before this, he worked on financial stability and central bank digital currency projects. Since we have two central bank senior officials here, let's start with the fundamental but important question. As many here already know, a central bank digital currency, CBDC, is a digital version of cash, which is issued and backed by central bank. But with so many existing payment options, from cash and cards and apps like Google Pay, so the question is, why do we actually need CBDC? So, Mr. Geiger, what are the main motivations behind Digital Euro project, and why is it important for ECB or Bundesbank?
Yes, let me start by also thanking for the invitation and the great opportunity to speak to you today. So the Digital Euro project was launched a few years ago as a proactive response to structural changes that we have seen in the payment sector. Maybe the general public, certainly not the experts with you, were thinking why we even need that, but we already see certain developments that make us certain that we, as Bundesbank, would advocate for the introduction of a digital euro. As you all know, decisions in the EU or in the euro area take a few more people to agree on, so no final decision has been made yet, but we are certainly moving along the process of coming to the decision to going into the implementation phase. There is already conceptual and also infrastructure work done, so we are moving along. So why, you ask why we need that, let me point out three main parts why I think we need a digital euro. First is the resilience. What means resilience? Even in a very cash-based society like Germany, we have nowadays reached a point where only a slight majority of 51% of payments are still on the point of sale are still managed with cash. And on the value side, the advantage has already moved to card and other cashless payments. And in other countries in the Euros area and beyond, the cash part is already quite low. So we see a need that we still have central bank money, and this is cash, being available in everyday's life in the daily basic payment sector. And another part will plays a role, which is maybe more limited to certain parts of the population now, but we certainly see that growing, as the discussion has shown today. Stable coins and other cryptocurrencies making their way more and more, especially in the young generations, into the everyday's life. And we need also a digital currency that can keep touch with these assets that have been proposed by private actors. Autonomy and sovereignty is another part. In Germany, about 2/3 of all card payments are managed by non-European providers, especially Visa and MasterCard. Many European countries have their own national card system, but across borders, except maybe some cooperations between countries, it hasn't been really a success story that their cooperation. So the German debit card won't work in certain European countries, and this is an issue. That's why people use MasterCard and Visa card as opposed to their national system. And we see the digital euro as a means of payment to actually have the European system in place and in such a crucial infrastructure like the payment system is. And this already brings me to the last point that I mentioned, efficiency. As I said, the European card payment system is very fragmented, and the digital euro can certainly set a new standard for this system to avoid fragmentation. So you can use your digital euro device, whatever it may be, your phone, a card, or a wallet, in all countries around the EU and maybe even beyond that. We'll see about that. And actually, this is also a very much advantage in terms of efficiency, that the legacy payment systems that we have now, they are quite efficient for their purpose. They were designed for payments within the country, but they are not well suited in terms of interfaces or access points to other currencies or even other countries with the same currency. And I think when we now look at how payments work, we look at a much more internationalized payment system. So I think when we come to the digital euro or other digital currencies, we will keep that in mind and guarantee or make interoperability between currencies or different countries much easier. And I think this is a great chance that we have in front of us.
Thank you for that great start. Turkey is also actively working on its own digital currency. So, Mr. Öz, where does the digital Turkish lira project currently stand, and what are some key lessons learned from the pilot phase so far?
Thank you, Meral Hanım. I mean, this process was designed as 3 stages, 3 phases, and right now we are in the 2nd phase. So maybe I should go over what these phases are actually involving. The first phase was mainly doing some limited pilot tests on an end-to-end system. This end-to-end system consisted of the mobile application, the intermediary services, and the digital money system. Of course, we had cybersecurity as a cross-cutting system and concern. And also we have simulation environments and data analytics environments to complement these end-to-end system. But that was basically the core functionality, and the focus on the first phase was more on making this digital currency use in a more private way and to basically emulate the use of the banknote. So in banknotes, the users have sole ownership of the banknote, and so when we use it in our transactions, there is not an intermediary in between. But in digital, and also central banks does not really intend to do customer management, so there are intermediaries in the design, in our current design and in our projected designs. But the intermediary is mainly doing like the attestation, not the confirmation. And so that was the first phase, and in the second phase we are mainly focusing on introducing more private and more smart solutions. So the programmability layer that we are currently working on is an environment that brings public and private institutions together to develop the templates and packages based on the conditions that can be derived from digital identities, the verifiable credentials, and also the payment APIs. So we expect this to be a collaboration environment in the future. And also the second phase focuses on offline payments as well. So the main work on first phase was with mobile wallets, but the cards are also the predominant, I mean, based on user habits, they are the predominant choice. And so we are currently working on offline payments as a separate study with card payments. And the second phase is where we want to handle actually all the requirements that we've identified. Of course, new ones will come out, and even after a launch, if it's decided, so that there needs to be a legal framework for that. But if it's been decided to launch, even after that, there will be, actually some change. There could be some change. I mean, we've talked about earlier sessions, alluded to quantum cryptography, so there will be continuous change. But as of right now, what we've identified, we intend to cover them all in the second phase. Macro-financial analysis is also part of this. And the legal framework is also part of this. And the third phase will cover, if the decision is to move forward, the legal framework. So as for the findings, I mean, there is a lot already in the phase 1 evaluation report. But apart from these, I mean, what we find out through, in the pilot test, is that users are not really able to comprehend the difference of a digital money from any other kind of payment method. So what we've tried to do, both in the first pilot and now in the second pilots, is that we try to make ways that the users can see first the credentials, which basically makes, lets them feel that they have this ownership, and also try to visualize ways that digital money is more similar to banknotes. And also, if it's just the mobile app, you cannot really make that difference. So different form factors will need to come in play in the future as well. Because as a central bank money, you need to cover 100% of the population. So not just mobile or just future phones or just cards. Earlier sessions also covered wearables. So there could be really very different form factors. And what we've also wanted to do in the second phase is that we can, through the pilot tests, through gamification processes, we want the users to actually know what they are doing and get the hang of the process, so to speak. And another finding, and this is maybe more like a challenge, but we found out that it's much easier to design a medium of exchange, but it's quite hard to actually design a store of value. So if we want to treat it like money, so there's, as you know, there are these functions, but with the holding limits, and we need these holding limits because of the financial stability implications, it's quite hard to maybe just design the money as a whole. So, and also as central bank, we don't really intend this to be like taking up a huge space, and we need to find a balance to the attraction of it, together with the banknote and the bank deposits. So that's also has been a challenge, but these are the things that we've been working on right now.
Thanks for the update. It's great to hear firsthand how things are progressing. Let's now shift to how CBDC might impact commercial banks. Some people argue digital currency could reshape how banks collect deposits or issue loans. So, Mr. Geiger, in your view, what impact might a digital euro have on commercial banks in Europe, especially regarding deposit management and credit creation?
Yes, I think when we talk to private banks or commercial banks in general, we get two main concerns. I come to deposits and loans in particular later. One is wherever it may be, especially from deposits, that we may crowd out commercial banks from the deposit and sector and risk them losing revenue. Also in the payments field, that for the customer, digital euro payments will be free of charge, but of course on the retailer side they can collect will be able to collect certain fees for their services. And also, what is very important to stress that in Germany right now, for example, 2/3 of all e-commerce payments are managed or are paid by PayPal. And German banks don't earn anything on PayPal payments, maybe except the one bank where all the PayPal payments run through. So this is a new field that could eventually bring new revenue streams to commercial banks, actually by enabling banks to advertise to their customers to use the new European-wide system. Because, there were so many different systems proposed over the time that have the ability to pay for e-commerce purchases, but they have never been really caught on. PayPal was universally available. It was always there, so people got used to it over time and used it out of convenience, even though there were alternatives. So I think the issue that there will be a loss of revenue is rather low, because business models are evolving and maybe even they will be increasing. The other is the issue that has been raised multiply is that the digital euro may lead to sudden outflows, especially in times of stress. We intend to counter that by a holding limit, wherever high it may be. You hear numbers of 3,000, 5,000 per person. This is just a random number that we use in many calculations, hasn't been put out yet. And if maybe the system becomes more established, maybe also the holding limits can be increased, so they are already relevant in times of crisis. We also will have mechanisms so you can make purchases even beyond that holding limit, but you can just not keep it the more than the holding limit on the account. I think this is also already addressing the issue that deposits may be drawn from commercial banks, because if you can hold 3,000, you can already hold this in terms of cash if you choose so. It doesn't incur a huge cost in terms of holding, and especially since the EU Commission has put out a proposal for regulatory saying that digital euro will not be interest-bearing, so there is no incentive for the customer to draw the deposits which in normal times actually have interest rates, and the digital euro will not have interest rates because it's primarily designed for the payment, not for holding deposits. So we will stick to a two-tiered system. We will also make use of the commercial banks' connections to the banks, to the customers when we introduce a digital euro. There will be maybe some kind of way to directly go to a central bank, but this will be rather plain approach, and the banks have much more opportunities to add additional value to their applications that the digital euro will use. Yeah.
Thank you for shedding light on such a critical topic. Let's now talk about how digital and traditional system might work together. The digital Turkish lira is being developed with a unique structure, but it's also expected to work alongside our instant payment system FAST. So, Mr. Ross, how do you see the long-term relationship between traditional system and digital currencies? Will they coexist, or might one eventually replace the other?
Okay, so the obvious integration that we have in front of us is that the conversion between the deposits and the digital Turkish lira, and for that we need to integrate with either FAST or the RTGS EFT systems, where the liquidity is actually. But right now we are focusing on FAST because it's 24/7, and digital money, let's say, issuance should be instant and always available. So right now we are focusing on integrating with FAST. But in the end, to your question, fundamentally we see that the payment systems, they are basically the rails, right? So we are focusing on designing a digital money. It will have its own rails, both maybe unique and also reused. We consider some of the layers, like maybe the programmability layers that we've been developing, it's going to be it's going to carry a lot of use cases, but that could also link to fast existing payment systems as well. So, we are not really seeing that they actually compete with each other. We see the digital Turkish lira as a complementary payment channel. It provides redundancy in case of, let's say, some disaster scenarios with the offline functionality as well. So it has its own different use cases, and the payment systems also has their own use cases. So the integration right in front of us is the conversion, and then I think it will still be like in some capacity they're going to work together as well.
Thanks again. Let's now look at things from the user's perspective. As digital payments grow, we're seeing big changes in how people interact with financial services. So, Mr. Geiger, in your opinion, which part of the European payment system is changing the most right now, especially in terms of user experience?
I think, and hearing the discussion today, maybe Turkey is actually 1 or 2 years ahead of that with the introduction of FAST. But for the European system, for the user experience, I think where users, especially in Germany and also other countries that haven't had that for the national banking system that much, is the introduction or the widely availability of instant payment. Our system TIPS, which is short for Target Instant Payment Settlements, will have a big impact on how payments are done, especially on the retail market as well. Now being available 24 hours, 24/7, this will have a huge impact, especially since these services were usually quite expensive before if they were available, and this is going to change now.
Thank you, very insightful. Let's go one step further and talk about infrastructure. One more for you. The Euro system is, as far as I know, is making instant payments mandatory, so that's a big move. What kind of impact will this have on payment infrastructure in Europe?
Yes, exactly. That's what I was already starting to mention, that TIPS is now available, and step by step, multiple functions or mandatory parts will be active. So since April last year, the regulation on TIPS came into effect, and from the beginning of this year, actually banks are required to be able to receive instant payments through TIPS. And also there is a requirement for having the TIPS payments equally priced to standard transactions, which means that at least in the German case, usually they will be free for the customer. And that's a huge change. Some banks were charging per transfer €1 or even a percentage before. So now I suppose that even if banks even ask their customers, and some banks still do, you want to do this as an instant payment, or some banks just do it as an instant payment anyway. But the vast majority probably will use instant payments instead of our standard SEPA clearer, which takes up to 1 day still, which is quite fast compared to previous years, but it's different than having it instantly. And also what's new is from April this year is that we have mandatory daily sanction screening, so the banks have to screen the instant payments for people or institutions that may be on sanction lists. And what will change and complete this mandatory part is that from October this year, also banks need to have the opportunity to send these payments. Before they only had to receive it, so if some other customer or other entity wanted to send to their customer, they needed to be able to receive it. Now from October, they also need to be able to send them themselves. And also, what's maybe will cause a bit of a different experience, there will be a mandatory verification process of the name of the recipient, because instant payments, they are final. It's hard if you make a mistake to get the money back. So if there will be a typo or some sorts, I'm not so much into the technical parts of it. They may get an initial error mistake, but it's eventually a good thing to avoid wrong transfers. So this will especially change the experience in the Euro system, and I acknowledge that Turkey was maybe a couple of years ahead. I will blame the complexity of how everything works in the Euro area, with having 20 countries, soon to be 21 countries on board, but this will be a huge step for us to have TIPS as a mandatory part of our payment system.
Yeah, thanks. Let's now move on to the topic of digital payment independence, especially in countries where most of the transactions go through international card networks. So turning to Mr. Öz, what role can CBDC play in terms of payment independence?
I mean, we see digital money as a natural consequence of digitalization. So that's the first thing, and then we focus on the benefits, and which are, I mean, we've gone over this in the earlier sessions as well. Basically, improving efficiency and reducing costs, and maybe improving transparency as well. I mean, as for the card networks, Sebastian also covered this, I think, in his first answer. But I mean, there are also existing rails and central bank money and card payment scenarios, card networks. In some cases, can also work together. I mean, in some payments or a series of payments, the first step could be done by the user with central bank money, which will then convert to and then be used in the existing integrated card network. So they are not really exactly versus scenarios. But for the monetary sovereignty part, always central bank plays an important role in the current design of the financial system. This anchoring function of the central bank money, because when you do a transaction, do a transfer, you expect the transfer to be at par. So what's protecting that value is actually the settlement at the wholesale level through the central bank money. So digitalization of that part is actually a significant goal for central banks to actually, let's say, remain in the game because of the proliferation of these many private money or money-like instruments as well. And many countries also see the decline of cash in their countries as a reason to issue CBDC, because in that way, if you can actually issue the equivalent of physical cash, and if the users adopt it, then it will be a way to actually preserve your monetary authority and basically protect the efficiency of your policies. So CBDC is actually quite important for the monetary sovereignty debate. But also, I mean, the whole anchoring is actually more on the wholesale side. But still, I mean, providing a digital cash and what we're doing in the first phase is more focused on the retail side is also a significant goal.
Thank you. Let's stay with you, Ms. Rose, and moving forward on national borders. There are discussions about using digital currencies for cross-border payments. Some even argue they could become new reserve currencies. So what's your view on this? Do you believe CBDC could play a significant role in shaping global monetary system?
I mean, for cross-borders, again, the main issue would be to transform, not transform, but maybe actually improve the cost and the transparency, the speed, and basically improve the efficiency. So there are a lot of different cross-border models, designs in the CBDC space. But the main thing, I mean, they use central bank money, so that's different. But also they involve networks of central banks, which is also quite different from the current design of the space. So I mean, when you come to the question of using, I mean, becoming a reserve currency, that depends on a whole lot of things. So the main, I'm not maybe the main, but one of the most important points in developing these cross-border platforms is that you can actually use local currencies in them, but that also depends on the depth. And I mean, this is also a goal in some action plans in some countries as well. But in the end, it's not really that easy to come up with just a single common platform. So there are projects aiming for that as well, but it may not be that realistic. So what might happen, there could be many common platforms, but there's then also the integration issue of those. And then there is the issue of who will be the system operator. So DLT takes us only so much. I mean, a distributed governance might be possible using DLTs, but in the end, there would be a need to have a technical operator. So what I'm talking about is that there will still be fragmentation. So, and this all actually, this is also important in the reserve currency discussion.
Thank you. And to close, Mr. Geiger, let's take a look into the future. With AI advancing rapidly, some believe payment system would evolve from something passive tools to active decision makers. Do you think so? And if yes, what might that mean for the future responsibilities of central bank?
I guess if you asked me maybe 1.5 years ago, my answer would have been slightly different with the sudden appearance of ChatGPT and many other large language models. We have seen the the power of AI right at our faces, like in daily use. So what these models can't do yet is that you give them orders and they go to other systems and operate systems there. But I think this is just a matter of maybe months. I know I've heard from certain colleagues that these are already in development, so it would surprise me if they weren't reaching out to the payment sector. There can be various applications in the payment sector, from predicting behavior, also including fraud detection, which I'm sure some banks already use similar techniques. If you would call that AI or not is always a bit of a question of definition. But there will be other applications of AI, managing liquidity, or, as you said, making decisions on behalf of the users in the end. I think this will eventually be implemented if the AI develops further. And also, I think we will see systems where AI processes will manage the entire process of a purchase together. So, and I think actually digital currencies, digital central bank currencies that you mentioned, that was our first topic, could play a role in this mechanism of involving AI. To your question, what role central banks will have in that? Sure, I mean, we also need to adjust to the AI coming more to everyday's life. One very obvious answer is that our oversight as the European Central Bank or the German Central Bank, we are also partly responsible for banking supervision. Our on-site teams are already looking into IT very closely. That has been one of the on-site inspection focuses. But AI requires certain competencies in our on-site inspection teams to be able to actually see if these systems work properly. And what will be the main part, I think, of central banks' role in this is advising governments or even implementing where they are responsible for it, for the standards. The standards, how should the standards look like? The standards, in my opinion, should emphasize transparencies as far as possible. I mean, when you put a request to an AI, it will give you a result, but you definitely don't necessarily know how it reached the result. It may focus just on very artificial artifacts that are not really part of your actual decision making. So there needs to be a focus on that, how to reach certain quality standards, and also accountability, that in the end it's clear the bank, the financial institution, or even an individual is responsible for the actions. That the AI cannot just say, oh, it was the AI, it's not my problem, we are not liable for the damage that has been caused. And it also raises an issue that's very important in my country. It's data privacy and data governance. Because AI necessarily needs data to function. It needs to be trained for certain cases. And it will also use data of other people, other institutions to make your decision in the end. And to which degree we will allow that, what standards apply for privacy in this regard is, at least to my knowledge, still an open topic, and that we need to be addressed in the future. It can also cause systemic risk, of course. I mean, we have seen the discussion was even with ETFs, but I think with AI we have that even further, that you will have certain pro-cyclical processes that maybe nobody really understands why all AIs in the banking system or in the financial system suddenly come to this decision, and then it may cause a certain systemic risk, and I think we need to understand that and find regulatory measures or adjust our regulatory measures to take account of that. In the end, it's always a balance act for us between enhancing efficiency and balancing risk, and there is no simple answer to that. I mean, it's a future topic, but that's probably one of the most relevant topic for central banks, especially in the payment sector, I think.
Thank you. And with that, we will wrap up the last session. Many thanks to you for sharing your insights, and to all audience for being with us until the end. I really enjoyed being here with you today, so see you next time.
Thank you very much.